I can't really remember ever seeing quite such a negative tone going into an earnings call. There's certainly plenty of good reasons to be anxious. Number one, Elon has a track record of generating a negative stock result when he is part of the call. Number two, while in most cases his comments age well, resulting in later gains, that was not the case in quarter three. Number three, the potential for a huge miss on the 50% CAGR is not a happy thought. We've the idea that we would drop well below the 35% that we just had and maybe go down into the 20s, that's nobody's very happy about that. Number four, many are mostly worried about the tone. Here's an example from James Catt. He's at Tesla Fan MTL. He says a list of things that Elon Musk will say on the call next week. He'll say number one, order of magnitude. He'll say number two, prototypes are easy, production is hard. He'll say number three, autonomy will be the biggest asset, value step change in human history. Number four, Tesla has near infinite demand, but that the interest rates are too high. Number five, I don't have a crystal ball. Number six, the future should look like the future. And number seven, I see a path for Tesla to be worth more than Apple and Saudi Aramco combined if we execute well. So if you get the sarcastic, the sardonic even thing coming from another Tesla bull who is, after all, a humorist, or at least he believes he is, but this is pretty indicative of the sour mood out there. So I'm going to go out on a limb here. And I'm going to say a lot of the bad news is baked into the common stock price right now after 30% drop since we reached 300 or almost reached 300 earlier this year. Thus, there's a potential for a rally after the call, assuming Elon is not glum again. If he is glum, I do think a further downside is possible. None of that is investment advice. So this is Randy Kirk. I've got coming up, if you want to hang out, I know we've got football games and stuff, but you may want to hang in there because I'm going to do a very, very deep dive with the help of some outside analysts who I thought did a fantastic job of breaking down what we're looking at this week when it comes to the Tesla's earnings report. So we're going to do that in just a second after I touch on a couple of other news stories, but it's a fantastic analysis. And then I'm going to, of course, analyze the analysis. So also I've got Scott Walter coming tomorrow on the show. That'll be around 2 o'clock California time, 5 o'clock on the East Coast. And Scott Walter and I are going to be talking about Optimus and the competition to Optimus. And it's going to be kind of in response to some other YouTube videos that will be out this weekend that both he and I know about. Anyway, then we'll have the usual show Monday morning. We call it Monday morning, which takes place on Sunday night. And I'll talk more about that at the end as well. All right. This morning, I did the last 10 of my 50 predictions for 2024. If you haven't taken a look at those 50 predictions, you might want to, I'll put the cards down when we're at the very end. You might want to go back and look at some of those. I know there's 5 different programs that I use to do that, but I think you'll find them instructive. And I'm just saying, okay, well, all right. So here's what Gary Black has to say on the subject of the upcoming earnings call. He says, of course, if you want to look him up, it's Gary Black 00. All right, here is Tesla 2023 volume guidance from last year's fourth quarter's earning deck. What the guidance was, and he says he would expect similar language with a reference back to the 50% long-term production growth target. That dates back to the 2020 actual production, and he's calling it 509,700. I always use just around 500,000. He says that it would equate to 2.58 million. I use 2.53. All right, but this adds language that due to economic headwinds and higher interest rates, 2024 deliveries will be below the 50% long-term target. So we already had under the target last year, but the overall target was still made. We didn't have to hit 1.8 this year to get there, but next year 1.8, and it's a 2.53 is what we would have to be. So Gary says he expects a full year 2024 production target of around 2.2 million. Assuming fourth quarter auto gross margins of around 16% and a stable 2024 margin outlook. 2024 guidance of 2.2 million production or deliveries should be favorably received by investors, he says. Not providing any 2024 guidance would be a very big mistake and likely push Tesla back below 200. I think that if they come in at 2.2 million expected number, but give some kind of a bigger number as aspirational, I think he could be right. Now, James Catt, mentioned up above, has another post today where he is actually in line with the street on the earnings per share estimate of 79 cents. But he says nothing at all in that article about the all-importance guidance numbers. I think the guidance numbers is going to be more important, actually, than the actual EPS for the fourth quarter. So now, just to be balanced in my overall reporting about negative headlines all last week, let me say that today there were two good ones. One said, this is from CNET News, no car manufacturer on the planet rivals Tesla's success. Wow. Actually, that's not CNET, it's YNET. I'm sorry, I copied that down wrong. And then from Trefis, I don't know who Trefis is, Trefis, Dell versus Tesla. With return forecast of 74%, Tesla is a better bet. So they're anticipating a 74% return on investment if you were to buy the stock right now. And then shockingly, Forbes had this perfect storm. They had this headline, perfect storm to blame for cold weather EV charging woes, according to a study. Well, look at that. So Forbes is sitting there saying, shockingly, that all the fun and absolutely ridiculous headlines last week about the cold weather problems in Chicago were not due to anything that Tesla failed on. It had to do with a perfect storm. But let's take a little deeper look. Now, remember, I have not yet done this big article. Hang in there, because after this, we're going to be talking about all the details of this earnings report from Wednesday night. So here's the article, though, from Forbes. It goes like Forbes, yeah. Don't blame electric vehicles, including Teslas. That's the admonition from EV research site Recurrent after it decided to conduct what it called a quick analysis of charging data from 4,296 Tesla Model 3 vehicles this week in freezing temperatures. Recurrent looked into issues after some Tesla owners in Chicago complained they were stuck in long lines at charging stations in this week's frigid weather because it took longer than usual to charge cars, while others reported their EVs weren't holding charges. The culprit appeared to be an unfortunate combination of bum chargers, cold batteries, and even colder temperatures, according to Andrew Garberson, head of marketing at Recurrent. Now, it would have been nice to have the word Tesla in that headline, since the article is all about and only about Tesla. And the benefits of the pre-warming of batteries is only something Tesla can do. But no, in this headline, we're not going to put the word Tesla, only in headlines where Tesla looks bad, even if the driver is the one who screwed up. You will also are very unlikely to see this article repeated in other mainstream media reporting, but I'll be on the lookout and let you know if it does pop up elsewhere. Then you have the Wall Street Journal with yet another hit piece on the entire EV market with this ironic statement contained within it. Now, they're not just knocking Tesla in the headline or in the article. This is talking about all EVs and how horrible it is that we are being forced to jump into EVs. But in this double irony, I'm going to agree with John Kerry for the first time in my entire life. Here's what the article said. Amid the private jet set at Davos this week, Biden climate czar John Kerry attributed consumer resistance to EVs to disinformation. That's hilarious. The automobile press couldn't be more in the tank for EVs. Wait a minute. Let me read that. This guy says in this article that the disinformation is not the problem because the automobile press couldn't be more in the tank for EVs. Oh, really? Where's he living? What planet? All right, here we go. We're going to dig in now. We're going to dig into this article. From Forbes, Beth Kindig is the lead writer on this, and then IO Fund equity analyst Damian Robbins also contributed to the article. So this is going to be a bit long, but I think you're going to like it. Tesla Q4 earnings preview, margins likely to slip again. Well, you may not like that part, but we'll talk about it as we go along. All right. Tesla's Q4 earnings are on tap after the market closed January 24th. We know this, closing up a year in which aggressive pricing cuts helped the automaker top Q4 delivery estimates, reaching a new record and narrowly beating its 1.8 million volume target. Tesla's continued actions to improve vehicle affordability through the year have been detrimental to margins as average selling prices falling quicker than production costs. That sense actually makes no sense. The average selling price was not, well, I guess that would be slightly detrimental to margins. But anyway, that's not a very, let's just go on. Apparently, these folks disagree with Gary Black because Gary Black doesn't feel that they got any incremental sales from lower prices, or at least he believes they didn't get a benefit from lower prices that really helped them to get all these additional sales. And I'm going to say they're right and Gary's wrong, and that's with a big duh. Econ 101 teaches that when prices drop, demand increases. Moreover, let's keep in mind that part of the price decreases last year were just price decreases from crazy high points that were there because of the whole COVID thing. All right, let's go on with the article. We covered in the past how Tesla's lower selling prices in China are having a detrimental effect on margins, as well as assessing how low Tesla's margins could go. We reiterated after the Q3 earnings that this continued decline in margins highlights a broader concern for investors in that Tesla has provided no concrete guidance on how far margins will decline. This is huge and correct. They have not provided guidance. Now, why do you not provide guidance? You don't want to tell your competitors what you're planning to do in terms of lowering prices. So Elon put it out there, hey, we're willing to go to zero. Now, that was not concrete guidance. We're willing to go to zero margins in order to make sure that we move as much metal as we can, because we're going to make it up later with FSD. However, I think this is correct as far as the stockholders are concerned, as far as the stock investing public, as far especially as the institutional investors are concerned. They would like to have concrete guidance. No, we're not going to go below operating margins of, or we're not going to go below automotive margins of a certain number. He talked about some guidance in terms of what they wanted to get, but he didn't talk about a minimum other than zero. So they go on to say, Tesla kicked off Q4 with price cuts in the US for some Model 3 and Model Y versions after the Q3 deliveries missed. They missed expectations, and they raised prices in October after this for the long-range Model Y and for the Plaid, all-wheel drive, X-Plaid. But Tesla also increased the price of the Model 3 and the Model Y in China in Q4. And they did this, according to this article, due to rising production costs. I think they raised prices in Q4 as they usually do because they thought they could. Anyway, given these pricing trends, ASPs look set to remain pressured in Q4. So the average selling price likely to remain pressured in Q4, while production costs will, I mean, they say may, but they will decline marginally, or maybe more than that, a combination likely to cause margins to slip again. So what they're saying is average selling price will come down, the cost of goods will go down, but the cost of goods won't go down as fast as the average selling price overall during the course of the Q4. I think that's incorrect. I think what we'll see is for the Q4, average selling price did not decline, maybe even gone up a little bit, and that the cost of goods will have declined more than they're expecting. So that's where we'll get this margin beat. Anyway, they go on to say, it is imperative for the bull case that operating margins show sequential improvement in Q1, the upcoming quarter, should it fall into the low 7% range in the Q4 that's going to be reported next Wednesday. Assuming a roughly 10% quarter-on-quarter increase in operating expenses, about in line with historical trends, Q4's operating margin is projected to be about 7.2% for a 40% sequential decline. I'm sorry, 40 basis point sequential decline. That the analysis below looks at what investors need to know moving into quarter four, and equally important, a few red flags we're seeing going into quarter one and quarter two that people should keep an eye on. Now, I don't think that we're going to see a roughly 10% quarter-on-quarter increase in operating expenses unless it's because of R&D, and that's always a very positive thing. You want more and more R&D is a very positive thing. I don't think you're going to see it in terms of regular overhead. All right, but also I want to say that increasing margins and or keeping a roughly 50% CAGR is critical to the stock price. Although those operating margins of 8 or 9, 7, 8, 9, absolutely satisfactory for most companies. The problem is if you have normal car company margins and only increase your sales around 20%, you can't get the PE that you're used to. You can't get it other than if the other divisions start to become substantial enough that they're counted in, and energy and other services and such potentially can make that happen. And so when we start talking about the batteries, we start talking about the Optimus, some of those things that will come up in the earnings call, this is where the future really is. Let's face it. It's not going to be automobiles. It's going to be robots, either four-wheel kind or two-legged kind. That's where the future is, along with maybe Dojo as a service, energy, etc. Okay, so they go on to say that automotive margins remain a key item to watch, and that is true in 2024. Automotive gross margins, excluding regulatory credits, topped in quarter one at 30%, which were crazy, before slumping to 16.33 in quarter three, 2023. Quarterly operating margins peaked at 19%, crazy numbers, before falling to 7.6 in quarter three, 2023. Wall Street continues to search for a bottom in margins. Nobody expects it to go back to 30% for the automotive margins, or go back to 19% for operating margins. That's not going to happen. Those were crazy numbers. But they do want them to go back, I would say 23, 25% on automotive margins. Maybe in the teens with regard to operating margins would be what people will be looking for ultimately out of Tesla. So now you have to take into consideration both the average selling price and the margins were at ridiculous levels due to supply chain issues and the COVID nuttiness. So part of the drop that they're talking about there is about that. Some of the reduction to current lows is currently due to attempting to increase sales in a very tough interest environment. This is not an excuse, just a reality. You're trying to increase those sales. You're trying to sell more and more cars and get more and more cars on the road because you get your data, you get your future sales of FSD, you get your future potential for robotaxi, you get your future opportunities for software as a service, all these things that are potentially there, and even for buying, charging from the superchargers, et cetera. It just goes insurance, on and on, all these additional add-ons that can come later if the more metal that you put on the road. They go on to say, aggressive price cuts pulled the average selling prices below 45,000 in quarter three, a level likely to stay in place as recent price hikes for certain models are unlikely to aid pricing given the pace of cuts throughout 2023. I'm saying that they would potentially have gone up a little bit in the fourth quarter compared to the third quarter. Looking forward to quarter four, ASP is projected to decline 1%, or they're saying 1 to 1.5% sequentially. I don't think so. Impacted by recent price cuts and slightly higher mix of retail sales in China in the quarter, where they were just over 35% in China compared to 32% in quarter three. That could take a little bit of the steam off of any potential increase in ASPs. Anyway, I think the rest of what they're saying seems reasonable. Production costs were reported to have risen slightly in China during the quarter, resulting in a price hike. But Tesla likely, and I don't know what they're even talking about, but Tesla likely enjoyed favorable tailwinds to battery pack cost optimization as lithium prices continue to fall through the quarter. And in addition, Bloomberg NEF estimated lithium-ion battery pack prices declined 14% year over year in 2023 to $139 per kilowatt hour, with passenger BEV batteries falling to $128 per kilowatt hour. Now, I think it's fallen even more than that, but I'm not sure whether Tesla will have taken all of that into the cars that they're currently selling. Passenger BEV batteries, fell to $128 per kilowatt hour. Based on favorable tailwinds from raw material prices and headwinds from reports of increased production costs, I don't think those are there. Cost of goods is estimated to have declined between only 0.5 and 1% sequentially. I don't think so. So, moving on. As seen in the scenario analysis below, the incremental effects to gross margins from a 0.5% change in production cost negative, along with the higher ASPs, lower ESPs, that comes to make it critical that margins bottom out in this quarter and that we begin to see increases in the average margins going forward. And it'd be nice to see the margins call, the earnings call, that they might even say, we expect margins to increase in the second quarter or throughout the year. Our current assumptions, they say, point to a slightly larger sequential decline for ASP, an unfavorable combination for margins. So for quarter four, automotive gross margins projected at only 15.1, excluding regulatory credits and operating leasing. Including operating leasing, automotive gross margins would project to be 15.71, pointing to a 60 basis point sequential decline from 16.33. I'm going to call it at around 17.5. They go on to say operating margin may be approaching a bottom. A sequential decline in automotive margin likely spells another sequential decline for operating margins, probably, but they're not taking into consideration energy, etc. Though there's increasing evidence that operating margins might be approaching a bottom also in quarter four. I'm saying it's going to be better than they say. The broader concern, I'm going to repeat this, the broader concern for investors is that Tesla has not provided any parameters nor guidance to assess how low margins may go. Again, it doesn't matter in the long term. If you're a long-term investor, it doesn't matter. But for short-term investors, for the street, it matters. And there you go. And so there's every good reason to think that Tesla's not going to give projections on margins. I believe and hope that they'll give good estimates and good guidance with regard to the number of cars they're going to sell. And I'm just hoping that it's in a very happy way. Yes, we think it's going to be a great year. It goes on. Aggressive price cuts look to be easing, a tailwind for ASP inflection, while declining lithium-ion battery prices would add production cost reduction, a second tailwind for margins. It's imperative for the bull case that operating margins show sequential improvement in quarter one, should it fall into the low range of 7% in quarter four. This is crucial for earnings estimates to begin seeing upward revisions once more, as forward earnings estimates have fallen significantly over the past 6 months. For instance, quarter four's adjusted EPS estimate on June 30th was 98 cents. This was later revised to 86 cents in mid-October, and the current estimate has slid to 74 cents. Okay, and the 74, I haven't looked at my EPS estimate yet. I think it'll be higher than 74, but I don't know that it will be as high as I'd like it to be, but I haven't looked at it yet. And I don't know if I'll even get to it before Wednesday. I'm so busy. Anyway, quarter one's adjusted EPS estimate on June 30th was $1.02. And then October's revision put it at 95, and the current estimate is down to 81 cents. Quarter two's adjusted estimate in mid-October was $1.11, while the current estimate is down to 92 cents. I will be having all of these estimates eventually, probably sometime in February. We'll talk about what I'm looking at for first, second, third, fourth quarter, and for the year. All right, quarter one's trajectory from pointing to over 20% year-over-year growth to now suggesting a low single-digit year-over-year decline raises red flags for quarter two's growth forecast, even after a 2,100 basis point revision lower. Weaker than expected margins in quarter four and or quarter one could quickly see quarter two's adjusted EPS figures revised lower for yet another year-over-year decline. The bull case would need to have concrete evidence of margins bottoming in order to avoid multiple quarters, etc. Tesla has already cut prices twice in January by 3%, 3 to 6% on Model 3 and 2 Model Y variants, followed by 4% to 8% cuts on Model Y. The first two were in China and then some in Europe. This raises the risk that ASPs fall much further than COGS in quarter one, driving a sequential decline in margins. All right, near-term focus on volume growth. CEO Elon Musk emphasized in quarter two that Tesla is focused on volume growth at the detriment of margins based on his view that unlocking full autonomy will lead to substantial increases in the value of each vehicle and therefore Tesla. He's quoted as saying, "It does make sense to sacrifice margins in favor of making more vehicles because we think in the not too distant future they will have a dramatic valuation increase." And then that was actually not Elon, that was CFO, the new CFO, Taneja, I think it's pronounced. Anyway, I'm not sure that's how it's pronounced. And then they reiterated this in quarter three, saying Tesla is focused on reducing costs, maximizing delivery volumes, and continually making investments in the future. In addition, of course, Elon has said in Master Plan 2 and 3, 1, 2, and 3, I think all master plans, the goal is to get the price of the vehicles as low as possible. Quarter four's production of 494,989 took full year 23's total production to 1.85 million vehicles, with deliveries taking it to about 1.81. This represented delivery growth of only 38% year over year and production growth of 35%. This focus on volume growth via price cuts comes as Tesla is increasingly at risk of losing its title as the world's largest EV manufacturer on an annual basis. After losing the title on a quarterly basis this year to BYD, BYD extended its lead against Tesla in China, especially so in quarter four, proving that it can't be ignored as a fierce competitor on a global stage. This is absolutely of no consequence at all to Tesla. They love the fact that BYD is doing well, and the BYD's cars sell for a much lower price. So this is like the old Apple versus the rest of the world scenario back a few years ago. Good for BYD. So, and yeah, eventually we're going to be talking about the competition. Right now, the competition is really, really not the issue. Then they finally do a technical analysis. It's worth noting that the head and shoulders pattern that is close to confirming. This is the red. I'm sorry. If Tesla breaks below 203, then the lower target will be sub 100 as we likely press below the January 2023 lows. If Tesla's going to have any chance of a sharp uptrend, it would need to break above 264 and 280 in a vertical manner. If this happens, we can just start discussing the possibility of a 345 to 400. This is the green count. Oh, I'm sorry, let's talk about a chart that I'm not showing you. All right, so there's no chance that Tesla's going back to 100. The fundamentals have changed dramatically since a year ago, and they're going to be changing dramatically in the future, even if they only hit 2.2 million vehicles next year because of energy and so many other things that are going on. So this is not even an issue. So I hope that was useful. I wanted to do the whole thing because I thought it really broke it down clearly and concisely in a way that was pragmatic and easy for everybody to understand. All right, this story is also breaking X payments. So X.com, where you can find what used to be Twitter, they set up an X, they set up a new handle for X payments on X today. That's so hard to say. So X payments now has their own account on X. We would all assume that this means that X Payments is about to launch. We've heard it from Elon. We've heard, yeah. So we know it's about to happen, and we know that they've got some licenses in a bunch of states. So we don't have the confirmation of when this is going to take place yet, but it will be huge, of course. Remember, Elon started in life. His second business was in the peer-to-peer business, where he started his company at about the same time as PayPal. That was, and they were in like this toe-to-toe competition as they were both growing and growing, and they finally decided that the competition was not beneficial to either one of them, and they decided to merge. And then he eventually was forced out, and they sold the company, and he got a $160,000 payday. I'm sorry, did I say that right? He got a $160 million payday for about 3 years' work. Those funds were then used to start both SpaceX and Tesla. Yeah. So keep in mind, so this whole thing with X payments could be a very, very big deal. All right. Keep in mind that tomorrow at about 2 o'clock California time, we'll have a very special interview with Scott Walter. You do not want to miss that. So please hit like, subscribe, and notify so you'll be notified. And then about 5 o'clock tomorrow, we'll have our regular Monday morning show where we take a look at the financial news coming next week, including, well, I don't know what's going to happen next week. No big deal. Let's see, Tesla earnings. Oh, yeah. And PCE. Oh, yeah. There's a few other things, like a bunch of other earnings reports as well next week. All right, and yeah, it's going to be a wild and crazy week. Also, earlier today, we had a Brian White video where we talked about his analysis of the 2024 potential for Tesla to make and build 3 million cars. I promise you, I have confirmed this with multiple different speakers that Tesla can make 3 million cars next year. They probably won't. That's a big question. Why not? They've got the capacity. Why wouldn't they get there? There's a card for that show right there. Please place your order for your Cybertruck bottle opener. If you haven't already done that, you know you want one. I got a special right now till the end of the month at $20 per unit, no matter how many you buy. You buy one, you buy 1,000. Well, okay, if you want to buy 1,000, give me a call. We'll find a better price. Maybe even if you want to buy 100, I might be able to shave a little bit off at the 100 level. All right. But basically $20, no matter how many you buy. You do have to add $20 if you're not in the US zip codes. And if you're way over in Australia, New Zealand, China, South Korea, the Philippines, if you're over in that area, please add $30 to help defray the very high freight costs to get it there. All right, I think that is all I've got for you right now, and it's been great talking to you.